first hear the words interest rate, it can be intimidating, right? Well, I'm here to put your mind at ease. Let's say your friend loans you some money, and you promise to pay them back over the next year. That's a whole year your friend has to wait before they're made whole again. And basic economics tells us that money has more economic value to your friend when the money's in their pocket rather than yours. That's primarily because the lending the money to you takes away all the other potential uses that money might have been put towards. Plus, money tends to lose value over time due to inflation, but I digress. So to make up for that lost economic value, your friend might ask you to pay back a little extra on top of what you borrowed. That extra amount is called interest. Today, however, we're going to talk about situations where you're lending money to someone like a bank, for example. If you open a typical savings account at a bank and deposit the money into that account, you are lending the bank your money and the bank is crediting your account with interest in whatever manner you agreed to, and the bank generally has to give you your money back when you ask them for it. How much interest you actually earn on something like a savings account is where interest rates come in. Interest rates are percentages. For example, if you were to earn interest at a rate of 5% on $100 with no other factors coming into play, you might reasonably expect to earn $5. How interest rates actually work, however, is a little more complicated by things like how frequently interest is paid, whether the interest is compounding, or whether the interest rates can change. An interest rate that can change over time is called a variable interest rate, by the way. That's something you should definitely keep an eye out for, along with when and why the interest can change. For deposit accounts at most banks, other than their time deposit or CD accounts, the bank usually reserves the right to change an interest rate at any time for any reason. So to make understanding interest rates easier for everyone, there's a little something else out there called annual percentage yield, or APY for short. The annual percentage yield factors in all of complicated stuff like compounded interest and looks at that from a big picture perspective over an annual percentage, 1 year, and thus the APY can give you a nice straightforward way of identifying how much you can earn on a particular account or comparing the annual percentage yield offered on similar accounts somewhere else. Let's look more closely at an example to understand how the idea of annual percentage yield works. Let's say you have $1,000 and you come across a bank advertising a high yield savings account with an annual percentage yield of 5%. The interest compounds and credits to your account monthly. You open that account and deposit your $1,000. After 1 year, presuming you made no deposits or withdrawals, and there were no charges or other debits to your account, such as fees, your savings account would have a balance of $1,050. $50 is 5% of $1,000, right? And so you would have earned $50 in interest that first year. Pretty easy to figure out, right? What can be hard to understand about this is that during those 12 months, you were not earning the same amount of interest each month. Remember, compounding interest is a thing, and it can be something incredible over time. Albert Einstein once referred to the compounded interest as the 8th wonder of the world. Well, I know that was a lot to unpack for now. So this time, we're going to do something a little bit different. I'm going to let all of you soak up all of that wonderful information, and we'll pick this back up next week to go over the rest. I'll see you guys soon.